Today, folks, let's discuss what I personally consider the best possible ETFs for Canadian investing in a TFSA, an RRSP, an FHSA, and we'll take a look at even my personal tax-advantaged accounts and the decision-making behind why I hold these ETFs. And this is not a one-size-fits-all shoe. You have to take into consideration time horizons, income, risk tolerance. A 20-year-old with a longer time horizon can take on more risk and might look more toward growth ETFs like XEQT, whereas older investors might want more global diversity, more dividend income. We'll look at global market ETFs, those dividend ETFs that I personally love, and so much more in between. So if you're on a path to financial independence, if you'd like to retire early, join me. Hit that subscribe button. As somebody who has gotten returns only comparable to the likes of Warren Buffett, I know I'm gloating a little bit here, but my TFSA is annualized, 16, 17%, RSP is annualized 27%, and I am not perfect by any metric here. So if you think I could structure my portfolio better, let me know how you would personally do it. I'd love to hear about all of it in that comment section below. Starting off with my TFSA, and this has been an evolution, right? Like, this is something I'm showing you well after the fact of a decade of investing, and I've gone from a lot of individual stocks. I mean, over the year we had Google in here, we took a good gain on. We've seen things like Tesla in these accounts, but as I've made gains, I've migrated more and more to letting the index carry me toward retirement in the mid to latter half of my investing career, right? Like, I started when I was 23, I'm 33. I would like to be financially set by 35 or 40, but reality is that I'm probably not going to use this portfolio for a while, and I believe these to be permanent set it and forget it like ETFs, where I'm not managing individual investments. And the two I have in here is VIDY and VOO. I have these split between Canadian and US accounts because personally I would prefer to have direct exposure to the US dollar, knowing that if I take profit in VOO, I'm taking it in USDs rather than having it auto convert. And we'll do a comparable from VOO to VFE, which is a Canadian counterpart to VOO that I know a lot of Canadians love. And the reason I hold VDY in here is because not only is it a dividend ETF, but I do consider it a growth ETF. And in periods of down markets, again, I believe you need exposure to all markets because, again, growth markets in a growth period do exceptionally well. But if you have foundational recession-proof dividend stocks that will continue to produce cash flow in bad times, that cash flow is very nice to have to reinvest when the markets aren't doing so well and give you the potential stability during job loss to, have a bit of cash flow to save you potentially from having to sell too many shares if you are looking toward like retirement still and you're not in retirement. So you might want to have an emergency fund that you pair with some dividend income to ride those cyclical down periods. But in my RRSP, I'm a little bit indifferent in here because I'm not looking to capitalize on dividends. I know a lot of Canadians will point out that like the S&P 500 or US dividend ETFs, you do not pay the 15% over the border withholding tax that I do pay within my TFSA. But I'll remind you, I don't particularly care because, VOO to me is a growth vehicle, pays a 1% yield. I really don't mind. And I recognize that with 40% of my income, almost 50 of it, so $4,000 that I'm collecting here, a good chunk of that is sitting in my TFSA is getting taxed at 15%. But again, it's incremental and it's non-concerning considering, again, I look at it more of a growth vehicle than an income-oriented vehicle. But it's nice to know within my RSP, I'm collecting those dividends tax-free, at which I can reinvest at some point down the road. But I'm starting to split off into the diversity of getting some global market exposure. So concentration in the US, some Canadian, and then having an end-all be-all solution like XEQT to start driving the new investments for me moving forward. I told you guys, I don't want to just dive into global market exposure because I'm still so young. I want companies that I hold like Google and Meta, which I'm not currently holding in my tax advantaged accounts. They're in my corporate account, but I would like this kind of portfolio, especially with the exposure to the US, to continue to grow a little bit quicker while I start adding new capital to, global diversity. Because again, I still want the growth, right? But over time, I want wealth preservation as I scale closer and closer toward retirement. So we all know the S&P 500, right? Absolutely crushed 15-year bull run with a few hiccups of 2022 inflationary cycles out of the pandemic and of course the pandemic, but year to date up 17%. Nothing short of astonishing here, guys, with an annualized rate of return since inception. This only goes back to about 2010, keep that in mind, but almost 15% annualized. Again, I look at total returns, guys. You can encapsulate income, growth in income in global markets, and that's something that should always be on your mind, building a stable, well-diverse portfolio. But my God, if you're not focused on income, guys, there's nothing better than a 15% average annualized return. I mean, for every 100,000 I have in here, I'm making 15,000 a year, right? So, I mean, I've got over 100K CAD converted in my TFSA, 100K in my RRSP, and another 100 over, way over 100K, I think, within my corporate account. So you can see how those numbers quickly accumulate into basically a replacement salary for me, even at the scale of my portfolio today of only being $536,000. And again, I'm a guy that doesn't really mind selling shares need be. You know, you can figure that out and talk to a financial advisor if you want to figure out kind of a drawdown plan instead of just focusing on yield and income. But again, you're getting exposure. And I know people don't like the concentration, but the reason I hold these ETFs is exactly for that. I am very happy knowing that I'm getting the best exposure to the best companies at a time during a technological revolution. And that's what you want. There's going to be ebb and flow periods. There's going to come a time where maybe pharma stocks and biotechnology companies change the world and extend life expectancy by 20 or 30 years, and they start making up the largest companies in the world. They'll naturally ebb and flow because of market cap weightings. And I think it's a beautiful system that too many people are starting to shun away from due to concentration risk. I'll remind you, in the 1980s, energy made up over 30% of the S&P, and ExxonMobil was like the largest company in the United States. That's no longer true. ExxonMobil's not even in the top 10. But would you have sold the S&P 500 saying, oh no, I'm over concentrated? No, probably not. The other way Canadians can get exposure if you don't want to deal with the currency conversion is through VFV. This is literally a Canadian converted in the stock. I'm not a big fan of this because it takes away the control of my currency diversification. I don't mind converting. I'm not trying to play Forex here at all. I would just rather own US investments in their native currency, because we can see if you give yourself that direct exposure, which by the way, I can pull out US cash and spend it even here in Canada. But the reality remains that if the dollar starts to underperform, like here in Canada against the US dollar, you'll see kind of lackluster performance. And I want control over that. I don't want a stock doing Forex for me within the price. But again, I don't have anything against it. I think this is a very easy, simple way for Canadians to get exposure to the S&P. I'm just a bit more fickle about it. So you can buy VFV, but again, it is slightly underperforming this year because, again, the Canadian dollar clearly is doing a little bit worse than the US dollar. So VO up 17%, VFV up 13.6%. But in totality, literally in a total world market index, this is probably the more healthy approach for someone that wants more preservation. And I've been constantly debating on whether I should make this part of my portfolio and maybe even start putting it within my RRSP and trading out the S&P. But again, I'm very confident even having all of my money in the S&P 500. It's just the way I am as an investor, because I think it's enough diversity as it is. But VT, I think, is a great solution for many investors out there. The problem with global markets is there's ebb and flow periods of performance. This year, global markets crushed, up 20%, guys. Again, keep in mind a lot of US exposure in here, but those global markets, thanks to things like Taiwan semiconductors, the interest rate cuts that have gone on across the board have bolstered a lot of other countries, including emerging markets. I mean, you take a look at this, right? If the 5-year, you're up about 80%, comparably to the S&P 500, that's up 109%. It's considerably why I call the S&P a growth vehicle. But again, very low expense ratio, 0.06%. And I will remind you, VOO has the lowest of expense ratios at 0.03%. But VT, again, I think this could be a good exemplifier. Since 2008, it has annualized 8.41%, but within the last 10 years, it's been 12%. So again, lagging the US by a few percentage points, but nonetheless, much better diversity, safety, and security if the US does decide to falter. And if we take a look, you will see all the same stocks, not as heavily weighted, but you'll see your Nvidias and your Microsofts and everything else. But then all of a sudden, you'll see some foreign stocks like Taiwan semiconductors. If you take a look at the page from 11 to 20, you'll start seeing things like Tencent Holdings. And these are great, massive companies that are only compared to the market caps and has nothing to do with their regions. And I love market cap weighted ETFs. Why am I buying XEQT? This is a global market ETF. A lot of investors here in Canada will put against something like VEQT. These are just basically all-encompassed ETFs of ETFs. They're just fund managers that give you, different region exposure by buying ETFs that specifically focus on those regions. So let's talk about XEQT and why it's starting to become a larger piece of my portfolio. As somebody that still wants to cost average into the US, into Canada, but start inching in some global market exposure, I feel like XEQT does the best job of this. And the only way we can really tell is by looking at the region exposure. This ETF has annualized 13.7%, has done an exceptional job and is slightly outpacing the US this year. Expense ratio 0.2%, very reasonable. But again, it's an ETF of ETFs, right? And it also gives me a bit more exposure to stocks that I don't already own in Canada, because I mainly own VIDY, which is a dividend ETF. But regardless, I'm 43% US, 25% Canada, and then I'm getting more exposure to the rest of these markets, including Japan, United Kingdom, China. Again, it's not market cap weighted, but if you compare it to something like VEQT, just to take a look at the exposure rating here, which has a slightly higher expense ratio, which again, I'd still rather go with the lower expense ratio. Annualized returns very similar though, like they're very, very similar ETFs. But if we just take a look at the region exposure, so let's just keep scrolling down here, guys, we can see that the United States is about 45% and Canada's 30%. Again, comparably, the United States is 43% and 25% Canada. So again, I just want to get a little bit more away from these two markets, and this kind of helps me do that slightly. But, you know, they're apples to oranges, either or. I don't think you're going to make much of a difference, even in an account like mine. It's just me being a bit fickle in my own ways. So we can talk about some of the dividend ETFs before we talk about the growth ETFs, because I know a lot of investors gear toward these. With the onslaught of all these new investment vehicles that offer high yields, I would still focus on the ones that give us the best exposure to the best companies, offering some slightly higher yields, but great growth on top of it, like VDY, that's up 17.7%. Again, a Canadian dividend ETF that is dramatically outpacing the US with the yield that it offers, because obviously in the stock chart we don't get to see the dividend yield. But regardless, you guys know it, you love it. It's one of my favorites. It's annualized since inception, a whopping 11%, and gives you exposure, guys, to, you know, basically the big banks here in Canada and all those beautiful dividend stocks like Wealthsimple's Power Corporation. Talked about that in a recent video. You get exposure to, you know, Royal Bank, TD, Enbridge, the powerhouse energy companies like Canadian Natural Resources, and so much more. But regardless, maybe you want to get some international exposure and you want more dividend income. We've been talking about VIDY, literally VIDY lately, which is trading up a whopping 27%. Though it does tend to go through some cyclicalities, this has been the best performing period for this ETF. Since inception, going back to 2018, it's only up 58% excluding the dividend, but now we're living in kind of a new renaissance of global market growth. Now this thing is offering closer to a 3% yield. The management fee is a little bit higher than I'd like to see at 0.32%. It's still well below 0.5. 0.5 is typically my breaking point, but the sweet spot that I always chase for is around 0.2% or lower. Regardless, for the global exposure we're getting here, again, annualized returns, 10.4%. Not bad at all. Very exceptional growth. And if we take a look at the holdings, we can see that we're getting exposure to Japan, United Kingdom, Switzerland making up the vast majority of the exposure, while also Australia, France, Germany, Spain, you name it. This is giving you those companies that you probably heard of, things like Nestle, Shell, Toyota Motor Corp's in here. Nothing makes it more than a 2% weighting. Heavily diversified, guaranteeing some, you know, stabilized income and just great diversity. I love this ETF a lot for those looking for a little bit more global exposure. Maybe it's something over time that I could start putting in my portfolio to continue to diversify. But as somebody that still wants that growth, guys, I like the concentration I get between VDY, VOO, and again, the new exception of XEQT is, I think, my VIDY for now. But regardless, VYM is another great US one that I don't talk about too often on this channel, that I think could be a great exemplifier for dividends and growth over the traditional discussed SCHD. And the reason I like this one a little more than SCHD, great to low expense ratio, similar to SCHD. I know that the yield isn't as high at 2.45%, but the annualized returns 8.94% that recently been getting materially better. I mean, in the last few years here, year to date, it's been 12%. Over the last 3 years, it's been 17%, but it gives you more exposure to those mega cap US dividend stocks that pay yields, right? Similar to VDY, you're getting exposure to Broadcom, JP Morgan, ExxonMobil, Walmart, Johnson & Johnson. And I feel like this would be the more appropriate US version of VDY, just because it's, again, a market cap weighted, dividend oriented large cap ETF over the more traditional SHDs that are hand selecting those stocks. And let's talk about the growth side of this with the QQQ ETF, a favorite amongst a lot of investors out there for those that want to lean into growth, which I think is an exceptional ETF for younger investors. You just have to be a bit careful about how you weight this, because if you own the S&P, if you own VT and you're buying this, you're way over leveraging in tech, because the reality is, if we take a look at the holdings in here, guys, this is just a much more concentrated version of Nvidia at 10% almost, Apple 8.2%, Microsoft 8.2%. And the reality behind why I haven't bought it is because my fiance and I actually own these individually between all of our accounts to varying degrees, with more concentration in Google and Meta. And I would rather hand select the stocks, because some of these I don't believe in the values as purely similar to like Tesla, that I think trades at a very high premium right now, Nvidia, which I think might have some cyclicality to it, and I get a lot of exposure already through the S&P 500. So I don't want to continue to upper weight those, considering again, we own our own version of this where we've hand selected a few of these growth vehicles and made them, I think in combination, about 20% of our combined accounts, which could be a little bit more individual stock than you might be comfortable with. But as 33-year-olds, I think we can afford the risk at the scale of our portfolios today. But these are the ETFs that I would really focus on and consider, depending on your risk tolerance, time horizon, and what you're trying to achieve, between the S&P 500's VOO, VFE, looking at global markets with VT, XEQT, VEQT, the dividend side of things with VDY, VIDY, VIDY, VYM, and then maybe some growth into the Qs. Regardless, you should also take into consideration if you can stomach massive downturns of up to 40%, because it will happen in your lifetime. Doesn't happen often, but when it happens, you might be more comfortable having some exposure to some treasuries or GICs, ensuring that you can not, freak out if your account goes through like a Terrafor in April, where my accounts dropped up to 20%. Those are realities that you still need to take into consideration, even within your tax advantaged accounts. But again, I'm representing this as a 33-year-old who's comfortable taking on that level of risk and is mentally prepared and has lived through many scenarios very similar to the drops of the pandemic and the Terrafor. But on that note, I will pass the question off to you. I'd love to know what your favorite ETFs are, why you're buying them, and how you think maybe I should allocate my portfolio if you were in my shoes. Let me know what you think. And as always, I look forward to catching you in the next one.